How low can oil actually go here?
I think we've established the lows, Morgan, and I think we'll be $45 by July 4th. And there are 8 reasons for that. And on a fiscal basis, we have many things in the many jelly beans in the jar to address the crisis. But oil has bottomed.
All right, I want to dig into that a little bit more. But first, David, I want to get your take on that and whether you agree.
No, I wouldn't say that we completely agree there. I think that there's a lot of situations in the market right now that would lead us to believe that this $35 and change oil price can persist plus or minus $5 for the next couple of years. I think the market has been oversupplied now. It requires an OPEC cut, including Russia's contribution. With that potentially off the table now, we will be oversupplied in the back half of this year. And then there's certainly threats beyond that potentially Saudi Arabia would be producing at maximum capacity. And then I think we still have to factor in the contagion effect of a coronavirus-driven demand slowdown, which I think right now the market is really only trying to discount for one quarter in this first quarter here, but could certainly lead to lower demand the rest of the year. So I think we could theoretically go lower. I think down, sub 30 near term. I think we're already at cash costs for many areas. But I think if you do indeed see Saudi Arabia escalate this price war with Russia and exceed that 12 to 13 million barrel a day number in April, the market's going to continue drifting lower.
Joe, why do you think that you're going to see $45 crude come this summer, especially since there are so many uncertainties around coronavirus and we are seeing these inventories build and Saudi Arabia ramp production?
Well, the amount of marine oil and airline oil we use is minuscule compared to ground transport, which is going to grow 10% this year. We're below cost in many regions. The Saudis and Russians have a huge hatred for the shale producers and the electric car industry, but any countries who have a combined deficit of 250 trillion would be crazy to go to war with the shale producers in the U.S. who can outperform them. Gold normally on a historical, oil on a historical basis is usually it takes 200 ounces of gold to buy oil. Today, you can buy 500 barrels. 200 barrels versus 500 barrels. So oil is cheap by historical standards. Back in 2016, when we went to $16, we were within $40 on oil within 30 days. This is not the end of the world. This is a volatile commodity that has historically been volatile. And demand for certain products like petrochemicals, which use almost 7 million barrels a day, is actually increasing because of the shift by oil companies from making transport fuels to, in fact, petrochemicals, which is a strong market for them and their growth market. And very frankly, what was wrong with the petroleum market is it was, like a lot of victims of coronavirus, had underlying issues before this began. And I agree with David that, supply was out because of OPEC, shale, and the non-OPEC supply. Demand was down because of European recession and China recession. But the U.S. is strong, and we're not in a recession, and I don't really think we will be going into a recession. I'm not an equity trader, but with low interest rates, low energy rates, regulatory relief, and a president who's business friendly, I think when we reach into that jelly bar of solutions, we'll be fine.
David, if you're right, and we do end up with sub $40 a barrel oil for as long as a couple years, how much are you looking at the economic consequences for those geographic areas where oil is important? How much of an impact in the credit markets do you expect to see?
Well, first, it's a great question. First, Russia has already stated that given their reserves, that they can withstand prices at these levels for decades. I'm not going to determine whether that's a correct claim or not. You're dealing with international affairs. Saudi Arabia has already been running a deficit. They do have cash reserves that could outlast the impact of lower priced oil here for at least 3 to 4 years at this point, if not longer. But I do think on the other side of that, you're seeing a very real impact. You brought up the credit markets to U.S. producers, particularly the independents, even names as large as Occidental Petroleum that announced a large CapEx cut yesterday. I think you're seeing several large independents now cutting CapEx immediately by 30 to 40%, if not higher. We do think this results in almost a 400,000 barrel a day drop in U.S. oil shale production by the end of this year, another 500 plus by the end of 2021. And I think cumulatively, by the time we get to the end of 22, you'll see 2 million barrels a day off of the 12 million barrel a day market in the U.S. that's declined. And you bring up the credit markets, and we cover about 30 stocks right now. In our universe alone, about a third of that credit is coming due in the next year or two here. This is going to be a critical time. There's been policies proposed on the Hill, I think, today, where companies are asking for some easement around some of those reserve-based lending facilities and some of their credit issues. This is a situation worth monitoring, but you could see upwards of almost $100 billion of credit that's coming due in the next 4 to 5 years that could start stressing the markets here.
Yeah. All right.
I can comment on that.
Well, I think we're going to okay.
Hello. All right.
Yes.
I would like to comment on that. Apart from Cheniere and Apache, most of the oil producers, including Major Oil, do not have heavily leveraged balance sheets. They're all less than 8 turns. And with low interest rates and accommodating banks and an increase in M&A activity, which I think you will see from this crisis, where reserves are bought. I mean, one thing to point out is the contango in oil is such that we have almost a 30% return if you buy reserves and hedge $40 oil forward. And in a world that's searching for yields, there's nothing better than buying reserves right now.